Hello, everyone, and welcome. Thank you for all joining us. The Wall Street Blockchain Alliance is very proud to offer our latest global webinar, examining the new IRS Form 1099-DA for digital assets. My name is Ron Quaranta. I'm very privileged to serve as chair of the Wall Street Blockchain Alliance, as well as the moderator for this great panel of thought leaders. Before we begin, a little bit of housekeeping for today's session. Please keep in mind that this event is offered for general information and educational purposes only. Nothing is intended to constitute accounting, investment, legal, or tax advice. And obviously, any views or opinions expressed during the event are those of the participants. They don't necessarily represent the views of the Wall Street Blockchain Alliance, nor of our respective firms. This webinar is being recorded. All attendees will be in listen-only mode. Attendees, thank you so much for joining us. You're definitely encouraged to submit questions for each of our genius panelists in the Zoom Q&A function, and we will reserve time at the end to address some of those questions. We've got a great panel of thought leaders. Wanted to give them an opportunity to say hello. Let's go around the horn. Sean, say hello and tell everyone who you are.
Absolutely. Morning to everybody. I'm Sean Stein Smith. I'm on the faculty at Lehman College, and I've also had the great opportunity to chair the accounting working group with Ron and these other experts here since about 17 years. So I'm really in for this conversation to really break down what this form means, how it's going to be implemented, and all that good stuff.
Sean, thanks so much. Ms. Dean, thank you for joining. Please say hello, introduce yourself and your firm.
Hey, everybody. I'm Jessalyn Dean. I'm the Vice President of Tax Information Reporting at Legible. I am our in-house subject matter expert on all things 1099 reporting and cost basis.
Jessalyn, thanks for joining. Joey Ryan, my old friend, say hello.
Hey everybody, Joey Ryan, Senior Manager in the Blockchain Digital Assets Division at Markham. Been in the crypto accounting space since 2018, so it makes me kind of a dinosaur in all of this. Excited to be here though and chat about the 1099-DA form and kind of the implications going forward.
Joey, thanks so much. And then finally, the one, the only, Nick Fahrer. Say hello, Nick.
Yeah, thanks, Ron. Nick Farr, blockchain and digital asset practice leader at Forbes.
Thank you all for joining us. And again, your firms are all WSBA members. It's a privilege to have you as part of the family of members. Nick, let me start with you, and I'll bring up the form for the audience to see, but I wanted to get your couple of comments real quickly. You know, we often try to start with the foundational, how did we get here? How did we get here? What was the genesis of the form? I remember in the early days, all of us talking about how is the IRS going to value? We were kind of semi-joking about it in the early part of this conversation. And I remember thinking, oh, great, it's property. Wait, what does that mean? Nick, we've been through this for a while. How did we get here before we dive into the specifics of the form?
Yeah, so bear with me here. It's kind of a long story. I think we can go back as even, short as 5 to 7 years ago. There was still a lot of misinformation floating around that, crypto was anonymous. You didn't have to report it on your tax return, all those sorts of things. And there was a lot of misinformation floating around. And so a lot of taxpayers weren't necessarily reporting it on their tax returns. And it's also treated as property. So, 90% of these transactions, other than, just transfers from one wallet to another wallet, are taxable events. So there's a lot of information that needed to be reported on tax returns. IRS felt like it wasn't, and so they started this Operation Hidden Treasure, if you will, and started cracking down on taxpayers that weren't reporting. They've also issued John Doe summons to exchanges like Coinbase and Gemini and others. And so then eventually in 2021 we got the Infrastructure Investment and Jobs Act. It's really fun to say. And in that act, basically, as a revenue raiser for this infrastructure investment, they're going to start requiring information reporting for digital assets. Originally, it was supposed to be effective 1/1/23. IRS has come out and said, we need some time to issue regulations, so just wait until we issue final regulations, and then it will be effective. Well, we got proposed regulations last August, and now, the Friday after April 15th of this year, the IRS drops this draft 1099-DA on us, which is very much in line with the proposed regs that they released last August. And there's a 60-day comment period on this 1099 draft DA. So, this may not be the final version that we see But you know, one thing that's super interesting is I think the congressional intent here was to raise money, right? So they estimated that this will raise about $10 billion in total revenue. This new information reporting regime. What I think is super interesting is, okay, they're going to raise quote unquote $10 billion. I don't know how they came up with that number, but what is going to be the cost of them to actually you know, accept all these forms, have the software in place to go through and look at them all. It's honestly, I think it's going to be a nightmare the way it's currently written, which is why it's going to be super important for us to submit comments, and why there was a ton of comments that were submitted on those proposed regulations. So that's how we got to where we're at today.
Nick, thanks so much. I want to open it up to the rest of our panelists. And before I do that, let me share on the screen the form that we're talking about for some of the folks in the audience who might not have seen it. We don't necessarily need to step through every single item here. But Jesselyn, let me move to you if I could. You know, Nick had mentioned that this conforms in many ways with some of the proposed IRS regulations. What do you see, Jesselyn, when you saw this form, and what were the things that jumped out from the perspective of how difficult is some of this information going to be for the ecosystem?
The first thing that jumped out is for any crypto, holder that also holds equities, shares of companies, the 1099 DA very largely mirrors the look and feel of a 1099B, which represents the sale or exchange of traditional equities and other financial products. So the look and feel very similar. We can also see, we have to scroll down to the second half of the form to see that the IRS has maxed out the space on this, single page. So it's clear that they could never have fit this onto the 1099B. They really needed a new form to capture a lot of information that does not apply to traditional equities. The bottom half of the form, we'll see there's things about digital asset address, transaction ID. Those are things unique to crypto and blockchain that we don't have in traditional financial products. So look and feel very much like the 1099B. Second thing that jumped out to us was nothing surprising that most of this mirrors what we saw in the proposed regulations that were released in August 2023. It's important to note, though, we don't have to show the cover page, but for anyone that wants to read it later, there's actually sort of this disclaimer from the IRS on the front that says, hey, this form could change. And to those of us that have deeply studied the proposed regs and the form, it's clear that this does not yet consider all the comments from the comment period. And a lot of us really do expect that a lot of this stuff will change. The last thing I'll mention, item number 3, the only instructions that have come with this form are actually the instructions to the taxpayer, and they're one page. What we don't have yet is the instructions to the broker, the company that actually needs to fill this out to put the data on it. So there's still a whole lot of open questions, both from the perspective of getting final regs, but also how is a broker meant to actually organize and put the information in some of these boxes that don't really have much detail behind them.
Jesselyn, thanks so much. Joey, Sean, let me pull you into this. And again, as we examine the form, one of the things that popped up, and one of the items that we got pretty consistent feedback on, and it's certainly been reported in some of the news outlets, when we look at broker type involved in transactions, Joey, unhosted wallet provider. And there are a whole bunch of people in the ecosystem saying, wait, what? How are we supposed to get some of this information, and what does it mean? Sean, Joey, do you want to speak to that? What are they talking about when they talk about unhosted wallet provider? And on the other side of that question, how difficult is that information to actually obtain? Joey, you want to go first?
I'll go first. Yeah. So yeah, the I believe kind of reading through the initial release, they're talking about basically any the definition of a broker is any let's say platform or exchange that is in a position to know. Those were the exact words that were used there. So I think we're gonna really have an interesting time defining who is in a position to know and who is not. I'm gonna see I see that as a potential opportunity for a lot of kind of back and forth between the IRS and a potential broker to understand if they actually are required to be issuing the 1099B. Now, technically, DEXs, decentralized exchanges, are gonna have to fall under this umbrella. But again, defining the type of DEX that's used by individuals across the US and how the usage of those dexes are being used. Will be interesting to see how that kind of gets defined going forward to at least analyze, the definition of if you fall under this broker umbrella to then have to start reporting this information. So I think that's part one. And part two is the actual KYC implementation that DEXs and other, let's say, decentralized providers are going to have to start collecting. And it'll be interesting to see either the pushback or kickback from crypto users when they have to start KYCing their info, when they're performing DEX trades, et cetera, or decentralized transactions, outside of the centralized exchange ecosystem.
Joey, just for the audience who may not know, when you say DEX, by definition, we're talking decentralized exchanges.
Yes.
Sean, weigh in here, please. And I want to
Yeah.
expand the conversation to Nick and Jesselyn as well. But, you've been in the space for a long time, Sean. When you see some of what they're asking for, what's the feedback you're getting?
Yeah, and probably the first comment I have is if Joey's been in the space going back to 2018 and he's calling himself a dinosaur, then I'm some sort of pre dinosaur creature there. But in terms of the actual form itself, right? Building on the points raised by both Nick, Jesselyn, and Joey, one sort of the actual form itself is a straightforward sort of evolution and a bright line, right? Building on those regs issued back last August. And then ultimately the IRS has been, on the one hand, quite clear in its appetite to have more of this information collected in a consistent format. But as they have tried to actually narrow down, who is a broker, what is a broker, what entities are going to qualify as a broker. I was reading over some analytics on this reg, and there are some other questions, right? Because on the one hand, there are unhosted wallets who are going to be classified as a broker, but if you are a entity that develops smart contracts to allow traders to execute trades and you make income off of those trades, but you do no other services, you, as of right now, are not classified as a broker. Even though technically it would strike me that having that level of access to both the underlying smart contract and the trading algorithms would allow that entity to have access. So there are quite a number of open questions here as to one, who's actually going to be on the hook, right, as to how to collect this data, and then two, the real overarching question here is that, okay, if you are now a broker under these IRS regs, how do you go and actually gather all of this information, right? Because anybody here on this call, on this panel, I can almost guarantee, so I don't guarantee much, but I can almost guarantee that all of us will acknowledge the fact that even centralized players, right, the Coinbases, Krakens of the world, don't always have perfect records for tax purposes because of the ins and outs between, their platforms, DEXs, cold wallets, and items like that. So on the one hand, there are going to be implications on the individual taxpayer side, many of whom might have entered into crypto during 2024 during this recent bull market, who are going to be on the hook in terms of actually paying taxes on these transactions, trades, swaps, and all the rest. But then as far as the institutions trying to gather all of this data, that's probably, I would argue, going to be the most intense portion of that ongoing back and forth here.
Sean, thanks so much. Jesselyn, Nick, let me pull you into this. And I'm sorry, but I'm obsessing on this unhosted wallet provider issue. And I'm going to go a little bit off script here. Joey, Nick, you've commented on it publicly. All of you have. And when we look at how the administration, and I don't want to make it a political conversation, but if we're going to rip up the script, let's talk about how the government's treated crypto. When we talk about unhosted wallet providers, is this kind of a backdoor KYC AML tracking provision that couldn't be achieved by other means? And I don't want to overstate that, but Nick, let's start with you. Is this just another let's do KYC because everyone in crypto is bad?
Well, I'm in crypto, so I don't know that everyone in crypto is bad, and you guys are in crypto as well. So we'll just leave it at that. Yeah, I think, when I look at the screen here and I see the watermark, I see Treasury/IRS. And to me that says right away, okay, this isn't just a tax regime, right? The FinCEN falls underneath Treasury, right? And if you're a money service business, you got to register with FinCEN and comply with BSA AML. And so I think a lot of those same things are being implemented here in this regime. And I think, yes, it's a undercover way of trying to require some of these unhosted wallet providers to KYC, and really trying to dox a lot of the pseudo anonymous wallet addresses, if you will.
Nick, thanks so much. Jesselyn, please weigh in and introduce us to your comrade over there, over your left shoulder or right shoulder. Trying to
This
figure
is
out.
the Black Panther in the jungle, Chi-Chi. He's hidden himself a little bit. I'm glad you asked this question because I actually had this thought in my mind. I'm like, oh, I'm going to jump in with this. So perfect segue. I have two responses to this. The first one is the shorter one, which is, I think I wouldn't go so far as to say this is a backdoor sort of AML KYC exercise, for the simple fact that IRS rules allow you to transact with someone technically without knowing who they are. And you don't get a finer penalty for that so long as you do backup withholding on the payment to them. So within these IRS 1099 rules, if you can't obtain the identity of the person you're doing business with, you withhold tax and you've complied with the rules. That's not how AML and KYC rules work. So the second response that I have to that question is maybe a little bit more nebulous of an answer. So I'm glad I gave a direct one first. It's really easy for the news to get the clickbait articles out there that this very largely held narrative that crypto users or digital asset users are tax evaders. And so it's really easy to get these clickbait articles about how terrible all of this is and how terrible it is for the ecosystem. But there's a whole lot of crypto and digital asset users that fall into the bucket of people that would like to comply, that would like to pay their taxes. They just don't know how or when or what. And so, yes, there is always a bucket of people that don't want to pay their taxes and would rather the IRS not know about them. But we also have to look at the positive outcomes, which are the people that are asking for this information, the people that maybe do participate in decentralized activities and they want a tax report. And in fact, we have seen in the ecosystem, there are decentralized players out there, DEXs and DeFi, that have partnered with software providers to generate tax reports that don't get filed to the government, but help their customers to do their taxes because their customers are asking for it. So we hear a lot of this discussion, at least at Legible, of people that, or entities that might be brokers in the future, but today would like to actually be able to give their customers some sort of useful tax information to be able to do their taxes. That being said, I think it's I forget which organization issues this. It might be the GAO. There are statistics that evidence that when 1099 reporting is not present, tax compliance is below 40%. When 1099s are present, tax compliance goes up above 90%. And it's both because now the IRS knows about your transactions, but also because the customers, the taxpayers actually have a much more concrete sort of document in front of them, one pager that says, here's what to report and pay taxes on. And that's really useful for the taxpayer that just wants to be compliant but doesn't know how.
Jesselyn, really good points. Thank you so much for that. I want to peel back into some of the other details as well as we proceed further down the form. And the four of you know I'm not an accountant. I've just asked a lot of really dumb questions over the years. But one of the things that jumped out as well, Joey, weigh in on this. Nick and Sean and Jesselyn, please do follow on as well. Are cryptos now subject to watch sale rules? When I look at item 1I, what is this targeting?
Yeah, so that's currently not been something in the past that has been, crypto has not been subject to the wash sale rules, correct? So one piece of advice, non-tax advice, non-financial advice that a lot of crypto tax people used to or would provide is, hey, if you're in a loss position, you want to recognize some capital losses to offset some gains, go ahead, sell those cryptos at 11:59 p.m. on December 31st, and then rebuy in at 12:01, and you reestablish your cost basis, right? This has been kicked around as subjecting crypto to the similar wash sale rules that stocks and equities and other similar assets are treated to. I would venture to guess we are going to go down that path of subjecting crypto to wash sale rules going forward, although that has not been implemented yet, nor kind of passed through anything yet. So yes, that's a to answer your question, Ron. Item 1A is probably something that's going to be considered or implemented going forward.
Nick, is Joey wrong?
Um, well, I guess it's important to clarify that there needs to be congressional action in order for wash sale rules to apply to crypto, because as currently written, the code does not bring crypto under the wash sale rule, and I think that's what Joey was getting at. But there are cases where, for instance, it could be a security that's been tokenized on a blockchain that could be subject to that wash sale rule, because that is a security, and that kind of trumps this idea that crypto is not subject to wash sale rules. So there could be instances where it is applicable, probably more rare than common. But I think Joey's also right too, that they're probably also getting prepared for this congressional action that could happen in the future.
And that's a super important point that Nick just brought up. Anybody that's, let's say, participating or trading with like STO secured tokenized offerings, or definition of crypto that is a security, yes, that's going to fall under securities rules under the IRS. So yes, wash sale rules would apply in that instance or situation. But let's say, most tokens that any sort of experienced crypto trader is trading, if those are actual tokens that aren't kind of falling under, if I can speak today, falling under STO or securitized token guidance, then yes, it will not fall under the wash sale piece that Nick was talking about.
Yeah, and I would just add there that probably having that that sort of inclusion on the form does, I think, point to the fact that, as Joey outlined, that there is going to be action on this point, but also highlights the expectation, I would say, on this side of the IRS, that as more TradFi institutions talk about tokenizing existing financial instruments, that probably going forward, that talk is going to translate into more action. So yeah, that's going to definitely be a important conversation to have, both on the institutional side and for individuals that are buying, selling, trading both STO, cryptocurrencies that are native to a blockchain, and also the tokenized versions of existing financial instruments.
Sean, Nick, Joey, everyone, thank you so much. And for the record, for everyone in the audience, I would only jokingly say Joey is wrong. All of our panelists are never wrong. I want to peel back some of the layers as we move down the form. And Nick, if you don't mind, I'd like to come back to you, because you said something. You used the phrase doxed, and I know what it means, but for fossils like me, what are we talking about when we talk about doxed? And let me put that in a different context, because if we're going to talk about crypto assets and blockchain technologies and this idea of public addresses, why is that a big deal anyway? You're on mute, buddy.
Thank you. You think I'd figure that out in the year 2024? So, I mean, you're right. Like, public addresses are pseudo-anonymous, right? If you generate a new wallet and it has no connection to an on or off ramp like an exchange, there's really no KYC to track it back to who owns that public address. And so, if Ron, you go out there, you create a wallet, you don't have it connected to an on or off ramp, nobody necessarily knows that it's your wallet, right? Unless you go and share that information publicly. Whereas if that new unhosted wallet provider has to KYC you now to issue you this new 1099 DA, well, then that information is going to be in a database with IRS, and who knows who else is going to have that information, as well as the unhosted wallet provider. So they're effectively giving a name and address and social security number to those public addresses that are associated with those unhosted wallet providers. So dox means basically that you're just uncovering who owns that wallet.
For whales like Sean, I recognize that might be a big deal in this space, Nick, but thank you for the for the clarification. Jesselyn, as we move further down the form, and again, I just want to get some more of the details to help the audience understand that some of the complexities and some of the things that may not be as complex as we think. But one of the items that also jumped out was item 11A, sales transaction ID. And back in the olden days, when I'd buy or sell securities and we got a 1099, it was, the confirm number, the transaction ID. Are transaction IDs in the crypto space a very different thing? And how tied to that are things like, and I know Nick, you and Sean and Joey have talked about this, hashtags, for example. What's the complexity of transaction IDs?
So I've actually had a few debates about this with peers in the industry over the last few days. So, as you kind of said at the beginning, none of this is tax advice, but also a lot of this is going to change, and there's going to be differing opinions on these kinds of things. So transaction ID is meant to represent really the transaction ID that should exist somewhere on the blockchain. There should be a public record of that transaction. At a certain point in the future, this data will be useful to the IRS and the taxpayer for purposes of tracking ins and outs of assets and cost basis, because as assets move between exchanges and wallets, following its basis is a big, big challenge. That being said, there's not that much stuff that's going to get reported on a 1099 DA that actually has a transaction ID associated with it. That's mostly going to be decentralized activities and tokenized assets. And that's because most transactions that happen that are largely the centralized exchanges, big volumes, there isn't a transaction ID on the blockchain because all those transactions are really off-chain within the ledger, the internal ledger and record keeping of those exchanges. So by and large, I actually expect to see a lot of box 11A empty, and instead you'll see box 11D checked, which will basically sort of be the offset that says, hey, broker, check this box if the sale is not recorded on the distributed ledger, meaning it was an sort of internal record keeping movement between customer A and B, etc.
Jesselyn, thanks so much. Really interesting perspective. One last item before I stop the share. And again, we realize this is in draft form. There's a public comment period. Several of us will have or will probably be commenting on it. But Joey, Nick, let me come back to you on one last item. When we talk about transfer in 12B, 12C, when we talk about a transfer, are we talking about a wallet to wallet DeFi transfer? What are we talking about? And are there clear guardrails on defining what those transfers are? Nick, do you want to start that off?
Yeah, so IRS actually mentioned this in the proposed regs that were released in August, that there will be a time when there's going to be a requirement for transfer statements. So for example, if I have Bitcoin and Kraken and I transfer that to Coinbase, Kraken's going to have to issue a transfer statement to Coinbase and the taxpayer to also share what that cost basis information is, so that when I sell that Bitcoin on Coinbase in a future date, Coinbase has that original cost basis from Kraken. They've also said that, there's more information to come, and we don't know exactly when these are going to be required. So kind of TBD at this moment. So I think this is really just setting up for when we get that information.
Nick,
I'm glad you brought that up, because one thing I wanted to bring up was clearly in the proposed reg guidelines, they talk about definitions of what falls under the definition of a digital asset broker. We talked about centralized exchanges. We talked about decentralized exchanges. What does not fall under the definition of a broker? They're including, as of now, miners. They're also including, I'm reading here directly, hardware wallets that do not directly allow users to buy, sell, or trade digital assets within their wallet. MetaMask, as we know, allows users to do that, but other hardware wallets that is simply a wallet that connects to any sort of decentralized DApp or platform, decentralized application or DEX or anything like that. Those wallet providers will not fall under the definition of a digital asset broker. So this is where it gets fun, right? Because if you're transferring assets from a unhosted wallet that doesn't fall under the definition of a digital asset broker to your Coinbase account, well, let's just say it's XYZ wallet provider, and you're transferring your assets to Coinbase. Well, guess what? That wallet provider is not going to be required to issue a 1099-A, or at least initially fall under that transfer exchange of information. So how is Coinbase going to know what your cost basis is in that asset if you then, subsequently sell that asset on Coinbase, right? So this is where it's going to get super sticky and fun. And this is where kind of the current crypto tax headaches that a lot of crypto traders currently are experiencing probably aren't going to go away, and you're still going to have to be using crypto tax software if you're an experienced trader, kind of using unhosted wallets or centralized exchanges as kind of the reporting between those wallet providers. I don't think is necessarily going to be 100% from the get-go. So that'll be really interesting to see how that kind of falls out going forward.
Joey, when you say fun, I'm hoping you mean that in quotes, right? Just
Exactly. Fun for the whoever the crypto tax preparers are that love to dig into this stuff.
Joey, thanks so much, both of you. You raise a really interesting point, and Jesselyn, Sean, I'd like to do a little bit of a thought exercise, because Joey mentioned hard wallet provider, cold storage provider XYZ doing a transfer to Coinbase. We understand that dynamic. Joey, let me blow that up a little bit, because a lot of these providers also have online platforms that let them say, I'm going to take my cold storage wallet from provider XYZ, and I'm going to be able to sell my BTC in exchange for, Jesselyn coin, for example. And what are the implications for them in that instance? I'm going to throw that out for the group. I need a volunteer.
I think that sort of possibility is probably, to borrow Joey's phrase, one of the really fun and interesting cases, right? Because there are plenty of hardware wallet manufactured, cold wallet storage entities out there who, as you noted, have apps that enable trades. And so then it's, as many questions in this area come down to, it's going to be half legal, half tax, half accounting, and then half artwork, right? And so it really is going to boil down to how directly connected those, and there are going to be other factors too, but a question that does have to be asked relatively upfront is how directly connected or how integrated are the mobile apps and the hardware wallets. Going back to the IRS's qualifying statement, is the entity in question in a position to know? And if you are the hardware manufacturer or the cold wallet manufacturer, and you at that same entity level has that mobile app that allows hardware wallet users to conduct trades, then technically, as the regs are currently written, then even though you're a hardware wallet manufacturer, you would be technically classified as a broker. So I do think that there are going to be questions like that on top of the, multiple instances where there are gaps in record keeping between DEXs and other centralized players, or as has been talked about before, if there are some unhosted wallets who don't have record keeping, and there are other unhosted wallets who have been trying to get tax records up and running, as Jesselyn mentioned earlier, there are going to be quite a few cases sort of that, either gaps in information, missing information, or a opacity into, is company X actually classified as a broker? And all of that is absolutely going to be an opportunity for fun and some heartburn also out there.
Sean, thanks so much. And for everyone in the audience, again, thank you for joining us. Please do queue up your questions. We'll address them at the end. Nick, Jesselyn, Joey, just to follow on from what Sean said, he said a word that sent a chill up my spine, which was lawyer. And I want to just say I have a lot of lawyer friends. I love them all, but I don't want to overstate that example use case. But Nick, Jesselyn, Joey, do we suddenly need to make sure our lawyer's on standby when we fill out these forms in the future?
Well, to fill out a form, let's clarify, because there's two angles to look at a 1099 DA. There's the broker that actually needs to put the data on the form. And then there's the taxpayer that's receiving the form and putting it in their translating it into their 1040 personal tax return or their business tax return. If there are brokers out there that have not gotten legal advice as to whether or not they are brokers. They should. This stuff is really, really hard, and we don't have final regs yet. So I know that law firms are not typically going to be issuing legal opinions based on draft regulations. But for brokers that aren't sure if they're a broker or not, yeah, they should get advice. It might be a lawyer, it might be, general tax advisor. But I think on the taxpayer side, I don't think taxpayers all need to get a lawyer involved. Use your software, use your typical tax advisor as you've been doing. That's all also to say as well, like, these first few years, once this form goes out, it's going to suck. It's going to be really awful. That's because, like, we've already gotten into a bit of detail here that what a broker is really challenging. So there's going to be a lot of cases where taxpayers think they're going to get a 1099, but they don't, because the party says, hey, we're not a broker. And so the taxpayer still has to do something. They still need to calculate and pay their taxes. So where are they going to get that information from? And on the other side, there's going to be multiple brokers in transactions, meaning there are multiple parties in a transaction that could meet the definition of being a broker, and they may all need to report on a 1099 and duplicate the same transaction. So now you've got taxpayers that might get multiple 1099s for the exact same event, the exact same sale or exchange. And then they've got a big reconciliation mess in their tax return. And in that case, I definitely recommend getting a tax advisor to help you unwind that and not just going it yourself with online tax software.
Jesselyn, thanks so much. Nick, Joey, before we stop the share of this document, let's just build and kind of where you want to comment and expand on some of what Jesselyn mentioned. In the practices you are both at, do you see this kind of need for this, what I'll call ancillary capabilities tax advisor? And maybe in the most complicated of cases, and I certainly was being slightly sarcastic, Jesselyn, maybe a lawyer. Is this something that more and more frequently becomes a conversation with your clients?
Oh, Ron, if there's anything that I want this audience to hear today, I think it's what Jesselyn just said, is that this is going to be a big reconciliation exercise. There are going to be cases where, as she mentioned, taxpayers get duplicative 1099 DAs for the same transactions. There's also going to be situations where they get a 1099 DA with just gross proceeds listed on it because the broker doesn't know what the cost basis is, similar to what Joey just talked about, where you got a taxpayer transferring crypto from one wallet to another wallet and then finally to the exchange, and the exchange has no idea what the cost basis is. So this is going to be a huge reconciliation exercise to go from what was reported on all of the 1099 DAs that they received to what actually happened. And this is where advisors and crypto tax softwares are going to really come into play.
Shameless plug, at Markham, we specialize in this. So anybody that's going to be either currently experiencing the headaches that are out there today, the challenges with your crypto tax reporting, please come to us. And the challenges that will be on the horizon with this new 1099 DA, happy to help solve your digital asset tax reporting nightmares.
So for the record, Jesselyn and Nick will now also get their shameless plug later on in the webinar. Let me stop the share unless anyone on our great panel has any other questions or comments they want to point out here. I think we're good. Again, thank you all so much. Jesselyn, let me come back to you if I could. I want to kick off a conversation. And you had noted something very interesting in prep, and it really caught my eye when you mentioned something about end-to-end operating models for businesses. There are a lot of different types of businesses entering this space. And we've talked about centralized exchanges. We understand the business model there. But when you talk about end-to-end operating models, the things that businesses need to do in order to comply, the things that businesses need to do to minimize errors, what are your perspectives there? What are you kind of alluding to for the audience to understand?
Yeah, so what I'm about to explain is really aimed at the company that might be a broker, that might need to actually issue these 1099s. And we have to back up a moment in history. So Nick gave us a great history lesson earlier. I'm going to go even further back in time. Late 1980s, early 1990s, we had a 1099-B, and it reported the gross proceeds on sales of equities, securities, shares of Apple stock. Basis was not reported. And so it was always up to the taxpayer to calculate and support their basis, but the IRS at least had a copy of proceeds. And institutions, big traditional financial institutions where you can hold equities, Fidelities and Schwab's. I'm not, supporting any of these organizations, just so we connect the dots. They had many years to get proceeds right, to really nail that down in their business process of, we'll call it KYC in their customers, collecting social security numbers, collecting signed W-9s on ink and paper, then reporting proceeds, doing tax withholding where they needed to do tax withholding, until around 2011, when we got cost basis regulations, which finally required companies like Schwab and Fidelity, et cetera, to also report the basis of the asset that was sold on a go-forward basis. They weren't going to be responsible for making up past history of old assets. And even the cost basis regulations were phased in over a number of years. So when you sort of recognize that traditional financial institutions had 20 plus years to implement all of the regulations that are involved in reporting the sale or exchange of an equity on a 1099-B, it's quite shocking to realize that crypto organizations, digital asset organizations, are being asked to do all of that in like 2 years. And yes, okay, late 1980s, we were doing a lot of stuff on paper still, but still the level of effort that is involved for a broker to stand up an operating model end to end, which I'll step through what those things are in a moment, it's monumental. So I want to give a little bit of, call out to the brokers from the perspective that, hey, taxpayers, they're going to get this wrong for a while. And what an end-to-end operating model looks like is a broker first needs customer onboarding. They need to collect a certified tax ID number, social security number, or EIN from their US customers. They also have to document their non-US customers. We'll save that for another day, but it's documenting who you're doing business with and their taxpayer ID number. Then you've got this, what I call like the transaction module, where every time a transaction is processed, someone sells some crypto or digital asset, you need to sort of go back and check the profile of that customer to say, have I certified who they are? If not, does tax withholding apply? And if so, what rate applies? And in real time, make a decision as to what rate to apply. Actually bifurcate that tax withholding off, which is a whole complicated thing with crypto and converting it to fiat, because you got to pay tax withholding to the government in fiat, and then releasing the rest of the payment to the customer. Well, that's a really big software exercise if you haven't been withholding tax before. The second part of transaction activity is that a broker needs to implement a cost basis engine that tracks, calculates, and reports the cost basis of assets that are sold, but also the assets that continue to be held. This is what Legible does. Later, at the end of the process, you need the annual reporting process that actually says, of all the customers I have, which ones of them are reportable on a 1099 or other form, and of the transactions, which ones of those transactions are reportable, because not every transaction is a reportable transaction. And once you've filtered all that down and you've merged all the profile, customer tax ID number back with the actual aggregated transaction information, you need to report that both to the IRS and to the customer. So you need some place for people to download their 1099, a place for them to request amendments to their 1099 when it's not correct. You need a whole customer service process that allows tickets to come through from customers with complaints about taxes. And that means you need a training program for all your customer service agents to answer questions about 1099s and taxes without giving tax advice. And at the very end of this operating model is what I call reconciliation. It's amendments. It's also penalty notices from the government when 1099s are not correct. And how do you get new information from your customers and cycle it back through that whole life cycle? That's an end-to-end operating model. It's a lot to stand up. And these digital asset brokers are being asked to do it in a very short window.
I was just about to say, is that all? But it does seem like a lot, Jesslyn. Nick, Joey, weigh in on some of this as well. And obviously, Jesslyn did a great job of explaining that kind of end-to-end model for us. How are you seeing that evolve? How are your customers evolving? And again, not diving into the types of customers particularly, and is this going to be a very error-filled time period until we figure out what the heck the government and the Internal Revenue Service actually want. Joe, do you want to start that off?
Yeah, I mean, Jesselyn did an excellent job there describing the entire process from beginning to end. Again, just to add on to that, it's I think the biggest issue, and I'm reiterating myself or repeating myself a little bit here, is going to be from getting full compliance from every decentralized platform that falls under the broker definition, as well as potential compliance needed from the decentralized platforms that don't fall under the definition of a broker. So it's going to be these 1099 guaranteed, these 1099 DAs are going to be wrong when it comes to cost basis, calculating exactly your crypto trades, unless you're just trading on Coinbase and that's it, right? But that should be, straightforward. If you're on one exchange, and that's the only trading activity you have for the year, Coinbase cracking, etc., that should be fairly straightforward. That should be something that should be, let's say, calculated right. But again, going back to Jesselyn's operating model, having to stand all of that up, even if it's just for transaction activity within the singular exchange, still is probably going to have errors within that need to be ironed out in the first few years. It's definitely a heavy lift, and I'm very interested to see, the issues and errors that come about and how this is going to get ironed out by both the taxpayer, the brokers, and kind of how the IRS works, hopefully, hand in hand with people to help get some of these issues ironed out.
Joey, thank you so much. Nick, Sean, let me pull you into a slightly off-script conversation here as well. When, just on, again, that great conversation on the end-to-end business model. When we look at the things the IRS is putting forward, one of the conversations we've often had at the WSBA, and I'm sure you've all been part of that, has been associated with, a phrase I heard many years ago: the pace of innovation will never be as slow as it is today. And I look at the forms like 1099 DA as a draft, and I think about the innovation that we're seeing: NFTs, DeFis, wrapped tokens, DAOs, and all of this other stuff. Nick, I want to ask this question as respectfully as I can to a regulator in the IRS. Are they able to keep up with this innovation? Like, for example, when I look at something like this 1099 form, when you have a high frequency, high speed trader like a Sean who's belting out trades over and over again all day long, doesn't some of this start to break down, Nick?
So whenever I was a kid, I was the annoying kid that asked why to everything. And so that still stays with me today. I like to ask why. Like why did the IRS, write the regs this way? So when I take a step back and I go back to that congressional intent, right? Like their intent was to institute a reporting regime similar to what Jesselyn said earlier, to increase compliance to try to get to that 90% compliance, as opposed to under 40% when there is no information reporting. And so I think this is this is Nick's opinion. This is not Forvis's opinion. This is not Wall Street Blockchain Alliance's opinion. But I think that the IRS wrote the regs in a way to get as much information as possible without regard to if this would be easy on the taxpayer or not, and without regard to if this would be easy to implement on the broker side. I think that their main goal is to increase revenue by instituting a pretty strict regime here, and that's their ultimate goal. There was a lot of comments in that comment period after the proposed reg, so I hope that they take some of those into account, but we'll see. I know that didn't really answer your question, Ron, but
No, I appreciate it, Nick. It is certainly good perspective. And again, I was totally joking about Sean being a high frequency trader. He's too smart to do like that.
Doing some right now, actually. No, but to
pauses.
come on, yeah, pretty much. While I'm on mute. No, but the overall approach of sort of the U.S. regulatory apparatus, and again, only my point of view here has been, I think, to try to cast as, on the one hand, as broad a net, right, to collect as much possible data as they possibly can, with no regard for even if that data is accurate. It's more focused on trying to just get data out of anybody and everybody who's involved in this space, because, again, my own personal point of view here, there are several high level influential people down in Washington that have been quite publicly anti-crypto, anti-blockchain, all the way back to its earliest days. And so there is I believe, a concerted effort, and there are plenty of conversations on Reddit, crypto Twitter on this topic too. That a big part of this collection of this sort of enforcement via, or rather regulation by enforcement, or this sort of heavy-handed, one-size-fits-all approach to how data is collected is more about compliance, more about trying to collect data, and more about trying to control which entities are able to innovate in which way. And to echo onto your point, Ron, the absolute explosion in growth of applications, be it called layer two, be it tokenized payments, tokenized assets. I mean, that is going far too quickly, right? For any oversight agency here in the US or overseas to really keep pace. And so I would say, again, just anecdotally, from my own point of view, that the approach taken by the IRS is going to be more the approach taken by US regulators to try to sort of cast as wide a blanket as possible to, in their defense, keep pace with the innovation without having to issue new regs, new documents for every single new iteration of tokenized applications.
Sean, thanks so much. And for a fossil like me, I can use my old Netscape browser to use Reddit, right? You can explain that to me.
Yeah, absolutely.
We've only got a few minutes left, folks, and thank you so much for the commentary. Jessalyn, I want to come back to you, and I want to pull Joey and Nick into this. One of the things I've also discovered when I look at my friends and colleagues in accounting, when I look at them in law, when I look at them in banking, I feel like we're all becoming, in some way, shape, or form, technologists. Jessalyn, let me start with you. When we look at Legible and the work you're doing as a vendor provider in this really critical space, what role does technology play? And what, for Joey and Nick, how are the firms and the work you do evolving to force you to be technologists in some way? Jessalyn, let's start with you, please.
Going back to my story earlier, late 1980s, early 1990s, everything was still done on paper, and you needed to collect ink signatures. Even back in 2013, we were still fighting IRS requirements around ink signatures on W-8s and W-9s. In TradFi, it's still somewhat acceptable to most of their customer base to sometimes require paper. And sort of the middle ground is, okay, if I have to go to one of my TradFi institutions and download a PDF, okay, I'll fill that out on my computer and maybe add a digital signature to it and send it back to them. None of that is acceptable inside the crypto and digital asset space. The IRS rules have not really caught up to that, and a lot of these brokers are going to 100% have to be using technology because many of them don't have offices. They don't exist on paper. And so technology is so extra critical in terms of the software and the technology needs that brokers implement. But sometimes you're trying to put like a square box in a round hole because IRS regs haven't quite caught up to that. So there's a lot of business decisions that have to be made by brokers to say, okay, yeah, there's an IRS reg that requires this, but I'm going to lose my customers if I implement that reg that way. What risk am I willing to accept from there's a business analysis to say, all right, yeah, that's the letter of the law. Am I going to get penalized for if I don't get the ink signature? Well, I'm going to do this other digital experience because crypto users simply are not going to download PDFs and sign them and scan them back in. Yeah. So that's a long way to say the crypto user, the digital asset native user, is totally different than a TradFi user, what their expectations are, how fast they expect things, how automated they expect things. And absolutely, technology and software are the only ways that you're going to be able to do this. Manual Excel spreadsheets for brokers trying to report on 1099s is simply not going to cut it.
Jessalyn, thanks so much. Nick, Joey, when we look at your firms, I'm assuming you're both coding up things in Python at this point, or certainly auditing smart contracts, on weekends. But talk about the technology angle of this and build on, Jesslyn, your really great perspectives. How important is understanding the technology for what you guys do on a day-to-day basis?
As much as I love reading the Internal Revenue Code and the FASB ASUs, this is the fun part of the job, right? Is understanding the technology and working with technology. And one thing that I personally love whenever I get to work with clients is whenever I hear that they're messing around with a new smart contract or doing something new in crypto that I haven't done before. I go and do that on my own so that I can visualize it and learn the mechanics of it, and being able to do that as an advisor when your client comes to you and says, "Oh yeah, I locked up some crypto in a liquidity pool and I'm earning rewards on a daily basis, and doing all these crazy different things, and you haven't done that before." It's hard to relate to them and hard to give them advice on how to handle those types of transactions. So this is the fun part, getting to play around and understand what our clients are doing, and truly understanding the mechanics of how it works.
Nick, thanks so much. Go ahead, buddy.
I was just gonna kind of layer on top of what Nick said. Being able to understand by participating in DeFi activities, so bridging, staking, liquidity pools, all those kind of buzzwords that you typically hear in the DeFi community. When you actively kind of participate or are using those, either personally, for as an individual trader, or if you're operating a business and you're utilizing cryptocurrency for payments, or on your back end to be able to pay people, pay employees, or part of your kind of operational strategy, you understand kind of the thinking or thesis behind why some of those transactions exist, and what the purpose of those transactions are, bridging, staking, etc. And that helps you really identify what the end user or the end business is attempting to like transact or utilize crypto for. And being able to understand that from a kind of thesis or thought process perspective really helps to analyze the data that you're as a taxpayer or business, the underlying data within their digital asset transactions, being able to analyze and understand exactly what the intent was of the transaction and what the end user was attempting to convey or attempting to do with their transactions. So yes, going back to your question about kind of being data scientists, yeah, that's part of the job now. If you can't kind of compile data and I don't want to say manipulate as a word, but manipulate data into the form that you need to be able to properly report your transactions to the IRS or whatever reporting agency you're kind of manipulating the data for, you're in for let's say more fun.
Joey, thanks so much. I want to get to one of the Q&A items and then give you all about 10 seconds. We're running out of time. This is definitely outside of my wheelhouse, but Dion, thank you for writing in. How will this work with the OECD's upcoming CARF agreements? I need someone definitely smarter than me to respond to that.
Gonna take a first pass. I know Dion, so welcome, Dion. So the CARF, for those don't know it, it's an awful word to say, but Crypto Asset Reporting Framework is an OECD framework that allows for a standardized method for governments to share tax information amongst each other to track down people that are hiding assets like crypto, but also traditional equities outside of their primary country of residence. And the US has indicated that they will sign on to the CARF, which means they're going to be sharing tax data of non-US people back to non-US governments. And in order to do that, in order for the government to share data, they have to actually have the data. So one of the questions that Dion's getting to here is, does the 1099 DA facilitate the government's need to collect information that they ultimately need to share with other governments under the CARF? This draft of the 1099 DA does not do that, because we know that this draft is easily a year old. It's pre-proposed regulations. It's also pre-IRS signaling that they're signing up to the CARF. So we do expect there to be changes either to the 1099 DA and or other types of reporting like 1042S for non-US people that will need to accommodate this intention to share data with other governments under the CARF.
Jesselyn, thank you so much. We are just about out of time. For everyone in the audience, thank you for joining us. We will have the recording available as well. Dr. Sean Stein Smith, Jesselyn Dean, Nick Fahrer, Joey Ryan, experts all, thank you so much for being a part of this. Follow them on the internets. They are sharing their thought leadership on a regular basis. Thank you for being part of the panel, everyone. We will leave it there. Looking forward to seeing you all again very soon. Thank you, everyone, for joining us. Bye-bye.
Thanks.